Now we'll move on to the retail market snapshot rate summary. We'll go through the leasing trends, and then we'll look at large format shopping centres and then CBDs overviews. And then we'll discuss the COVID impacts and then opportunities for tenants.
Okay, large format retail is still performing quite well. Over the last 2 years, people were spending their money on household goods instead of travel. It's also being driven by a lack of development opportunities in this sector. Shopping centres, however, we're still seeing a slight increase in vacancies, largely in regional and sub-regional centres. Therefore, we have seen a softening in face rents, and there are incentives on offer for new tenants as landlords look to fill up their centres. Neighbourhood centres are continuing to do well. Work from home has seen more people shopping locally. Therefore, increased foot traffic is leading to an increase in rentals. CBD vacancy, however, remains static, but we do expect rentals to decrease and incentives increase over the coming months, particularly in the Sydney and Melbourne markets, which were affected the most by lockdowns. Across all retail sectors, we do forecast rises in the annual rent increases. Retail rent reviews are typically based on CPI. The March CPI figures were released yesterday, and we saw an increase to an overall rate of 5.1%. This ranges from 4.4 in Sydney to 7.6 in Perth. So for those tenants locked into a CPI plus percentage review basis, these increases will potentially be substantial.
Thanks, Gillian. As Gillian mentioned, the large format retail has probably been one of the stronger performers in the overall retail sector as a result of the working from home and the increased demand in the household goods. As a result of it, we've seen a number of our tenants search for new space, in particularly in the household goods, for instance, the baby auto space also. With the increased demand, the face rents have actually stabilised. However, in some regional high-performing large format retail centres, we have seen a slight increase in the rent. What we're advising our clients is to review their portfolio and find opportunities where you can actually optimise it. An example of this is actually being smarter about the space, given the higher rents, and handing back surplus space that's not required, or relocating to a new location, which is actually better suited for the business.
In terms of shopping centres, the pandemic has really reshaped the landscape. Whilst neighbourhood centres have benefited from an increase in local convenience shopping due to the working from home factor, regional and sub-regional centres have experienced higher vacancies. So with the regional and sub-regional centre landlords, they're still insisting on maintaining face rents for existing retailers. However, there are increased incentives and lower rents on offer for incoming tenants, as Gillian explained, hence why we have seen a slight drop in rents for these centres. An area of retail that is benefiting from the incentives for new tenants in major shopping centres are international brands, now that borders have reopened. This will be a positive for local retailers, benefiting from increased foot traffic and lower vacancies. Move to the next slide. So with the CBD, the retail market is still severely affected due to the slow return of office workers. And the CBD is predicted to remain in distress probably until late 2023, early 2024. Incentives are mostly around 20%. They can be as high as 30, but mostly around 20. And this, along with reduced rents and outgoings, are attracting tenants to look at strip retail instead of shopping centres. Landlords in the CBD areas especially are more willing than ever to consider flexible lease terms and alternative concepts due to vacancies and the smaller pool of tenants looking for space in the CBD. Therefore, it is more important than ever for retailers, whether they're a SME or a larger tenant, to be able to take landlords on the journey of their business so the landlord can understand the need for changed lease terms to support the viability of the retailer's business. Examples of these flexible terms could be rent tied to turnover, a short-term lease, or break provisions. Overall, there is a lot of uncertainty from landlords in most retail markets at the moment, which will continue to provide opportunities for retailers to push harder for improved lease terms, increased incentives and reduced occupancy costs. Remembering that occupancy costs is one of the largest expenses for retailers. At LPC, we're really excited by the opportunity that the pandemic has provided in the retail landscape to change the rules of the game when it comes to lease arrangements. Landlords must be prepared to enter into a shared risk and reward arrangement with greater flexibility provided to deal with impaired or interrupted utilisation. Multi-site retailers especially have a unique opportunity to negotiate improved lease terms with shopping centre landlords. By leveraging the size of their portfolio and presenting a strategic roadmap, including the need for more flexible lease terms, major landlords need to consider change or risk increasing vacancy throughout multiple centres.